Ladies and gentlemen, welcome to Creating Tailwinds Podcast by Flight Path Financial with your hosts, John Urbick and Jared Adams. Join us today as we discuss the power of infinite banking. And here we go.
Hello, John. Greetings.
Hey, Jared.
Welcome back. Yet another awesome episode here. Thanks, everybody, for tuning in. We're moving on into part 5 of Becoming Your Own Banker by R. Nelson Nash. What's going on with you? How you been doing this week?
Having a great weekend, Jared. I'm left to my own devices for the week. Antoinette is down in Cancun meeting our son Matthew. They're going to go have some fun in the sun.
Oh, that's
and
awesome.
So I'm going to get caught up this week.
That's cool. So all the honey-do list that she left you with that
Too
you can
much.
take care of while she's gone.
Yes, sirree.
That's right. Well, we all know how that works. Well, moving on into part 5, capitalizing your system and implementation. There's a bunch of different topics that this goes into.
There are.
I think we'll end up breaking it up into. Yeah, we'll have to break it up to some sections. But, as he kicks off the chapter here, he talks really about, we're 65 pages into the book here.
Yep.
And he kind of gives you that one punchline that says, hey, by the way, I know you've read about this. I know it seems really interesting, but know that this is a function of personal responsibility. That, remember, you have to put the effort in.
It's all about what?
It's all about
Desire.
Desire and capitalizing your system.
You have to be the energy behind this for it to work. You have to.
Right. You have to be
Nobody's
driven.
going to do it for you.
You got to be driven.
It's not for everybody because you've got to be forward leaning and you got to make it happen.
That's right. Yep. So I think that's a good lead in for this episode, is to know that you've got to be the driving force behind what's going on, and you have to be involved in the process. You can talk to John or myself as agents, and we would love to make sure that you're set up properly. But at the end of the day, when you get access to your bank, you've got to put that in action, and you've got to know where that goes and what that looks like. Am I saying that right?
You are. I was going to hit one little excerpt out of the book, this is right from Nelson. And I think this encapsulates what we're talking about. He says, this is going to require a change in priorities in life and in recognizing that controlling the banking function personally is the most important thing that can be done in your financial world. And how best to do that? Find an infinite banking practitioner. You need a coach. Everybody needs a coach because you need like-minded people around you. If they're not in alignment with your way of thinking, set them aside, because that is just going to be an inhibition to you achieving the kind of success that you can with this system.
And I think it's good to point out, you said just aligning your priorities. He didn't say change your priorities. He didn't say change your habits and spending. He just said make sure your priorities are set up so that you're flowing this cash through your system first, and then as you get access to it, put it to use.
Precisely.
Yep.
Absolutely. Environment is everything. Above all, he talks about get started now. I mean, the longer this goes on, the younger you are, the better it is. But it doesn't preclude you from starting this thing at 70 years old, because it's a generational thing. It's a third, 4 generations downstream, and you can use that money while you're planning for a time that you're going to graduate. You're gone. So, but your family won't be. Your kids, your grandkids. There's so much you can do with this at any age.
I think that's perfect. That's spot on. I think we touched on that in a previous episode on how important it is to just get started.
Right.
It doesn't have to be, it's a whole life policy. This is guaranteed to pay out at some point.
It is.
But you don't have to set up your do-all, end-all contract today.
Nope.
Get started. Whatever the monthly amount is that you can start, or the annually amount that you can start, get that set up, get that rolling in the right direction so that you take control of the capital in your environment.
There is no time like the present, as they say.
That's right.
So let's roll into the retirement trap, Jared.
Okay.
What do you think?
Well, how long do we got? Maybe an hour, 2, 3?
No, we're gonna try to keep these podcasts down.
Okay.
Well under 30 minutes. We're gonna shoot for 20.
Okay.
We'll see what we can do.
We could go on for a long time.
Oh, this one, there's so much. We can possibly do something later on specifically on retirement, because it is so rich in content.
Right.
There's so much.
Yes.
But yeah.
Maybe to set the baseline, the assumption is, and maybe to have the glossary of index shared, so to speak, when we talk about retirement, we're talking about really passive income. We want to talk about a time that our money is working for us, providing
well,
a benefit.
even more than that, though, and you're right. You're absolutely right about that. Is the whole notion of retirement came into being after the Kaiser in the 1890s out of Germany, and then in the United States, pension plans weren't even a thing until after World War II. So what people don't realize is our forefathers, they worked. People look at the titans of industry. Those guys are working till they're 80, 90 years old. You don't have to retire. There's no set number. It's just an arbitrary 65 these days.
Right.
But you don't
So the
have.
Rockefellers didn't have any 401ks?
No. Oh yeah. No, they didn't.
Right.
They didn't, because Nelson talks about operating from a faulty premise, right? That's what he called it, a faulty premise. And that premise is that the government can satisfy our needs in our retirement.
Sure.
That as we see it today.
Yep.
It's a false narrative. We have to take charge of this stuff. Otherwise, nobody else will.
That's right.
Yeah.
So when we're looking at those years, when we're trying to generate the passive income, right, we're no longer working, but we need our money that we've saved up over all these years, and we need access to it. We want to be able to know that it's generating an output while we're not working.
Right.
Is that kind of the idea of kind of a big picture setup?
It is, but even more than that, what people need to understand is the IRS has come in with a solution that really wasn't needed, but it was a problem that they created, and now we have to fix as individuals. And so they turn around and they want to take all of our money through taxation, whether it's direct or indirect, and they're looking for how can we give people more money? Well, they're going to give you benefits. Where are those benefits coming from? Well, it's your money ultimately that's flowing into the system that somebody else controls, and that's how they're giving you the benefits. If you're wise, you're going to take control of your own money, creating your own opportunity for benefits. Much more efficient to do it that way. Think of the power lines outside and the amount of energy that is lost over those power lines as it's transmitted across county after county after county. What if that power center was right next to your house? You would use far less, probably on order of 80% less energy just because of all the waste. That's what happens with government.
Sure. So they created the problem.
Yes.
Then they created the solution.
Yes.
And I'm supposed to trust the solution.
Then you're supposed to fix their solution with your own. So you got two jobs to do.
Well, but that's the standard answer, is that we're supposed to understand that, government has allowed us to save money, tax deferred, and that's our answer to the problem they created. And I'm supposed to trust that that's enough and that's okay.
Yeah, that's what they would like you to believe.
Yeah.
Yeah. It doesn't work though, does it? I mean, look at the pensions throughout the country, Jared. Cripes. There's defined benefit, there's defined contribution, which is what we've moved toward. That's the 401k.
Yep.
The defined benefit, most of those now you're going to find in government agencies. That's where they're at the state and the federal level. The problem there is those things are terribly underwater, and the only way they're going to fund them is through an increased taxation.
Right.
Or increasing the nominal dollar value by printing more money, which is inflationary, which reduces your purchasing power. So why not take the bull by the horns and address these things now, well ahead of when you need them, so that you have something in the future that you can control?
Sure. That's spot on. I mean, I when I think about the retirement trap, literally as this is laid out, I think the trap is that you think you're saving to a spot that is going to provide you an adequate retirement, when really a lot of the goal that ends up is you're setting up funds on an expectation of lower taxes.
Yeah.
I mean, that's kind of the reason why these are all set up this way, is that if I put in money now, tax-free, so to speak, that when I get taxed on that amount later, the rate that I will be at will be less.
That's the assumption.
That's the assumption, right?
Right.
So how does this help solve that in terms of not necessarily the amount of taxes, but really an amount of taxes? It's a percentage-based system.
Right.
If we're at a 30% rate right now, you're at one of the higher income rate brackets. You want to live at a 15% bracket when you retire? So, is that the goal, to live with less?
I don't know that it's going to be 15%. All these people think they're going to be in these lower tax brackets are going to be sorely mistaken. Why? Because as they print money, we're going to need more money to live, and so people are going to have to make more money.
Sure.
What's that going to do? That's going to drive them into those higher tax brackets. And so even though they think they're escaping the higher tax bracket, they're creeping in a very insidious way up into those higher tax brackets. Look at what they've done to the Social Security contributions, right? Social Security, 2035, they got an issue. They're going to have to cut that thing by roughly, I think the number is 17% across the board, Jared. So there's that they can do. And the other thing that they can do is they can increase the contributions from us up to that whatever figure. It's about $150,000 a year right now. And then also the company contributes to this. So you've got from two sides.
Yep.
That's where the 12.4%, 6.25 from each side, 12.5% comes from. So what will happen if they drive those numbers up, requiring increased competition? That means the companies that you work for have to either reduce benefits or pay scales or delay them to accommodate those increases in cost. Companies are in business to make money. They're not in business to provide benefits to you. So it's something to think about. And why an IBC policy, after all of this, makes sense is because you are capitalizing a system that is guaranteed to grow, not like the negative rates of return you saw on Social Security over the past several decades. Those are going to grow tax-free. Perhaps 4% inside of these contracts. You're getting two components. You're getting a guaranteed interest rate, and you're getting a non-guaranteed dividend. But the dividends have only been paid for some 100 years, so they're pretty darn good. So you've got an increased capitalization. You've got a corpus that is growing guaranteed every single year. So down the road, when you need money the most, it's going to be there, and you're not going to have to go beg the government for something that they've already spent.
Sure. Yeah, when I have these conversations with potential clients, sometimes we even end up down the path of the flexibility that it provides too. Your company may be giving a contribution to your 401k regardless of whether or not you're giving. And so you're going to have some money into those different buckets when you arrive to 65. If you have, equal or larger bucket in an infinite banking contract, you can kind of pick which path is most advantageous at that time. Maybe the market just tanked over the last 2 to 3 years, and the funds that your company's been contributing over 30 years, maybe those funds are half of what they were. And yet you've got this beautiful IBC contract that's there available that you can pull funds out of to support whatever your habits are and lifestyle for retirement. Or maybe it's completely opposite. Maybe the market is way up. Well, pull out from some of those 401k funds, put them to use while your IBC contracts are continuing to grow.
Yeah. Now, I see so many opportunities coming right now, and I look at a pile of cash sitting there, and I've got a 401k. I got a pile of cash sitting there that is basically dead to me until I leave the airline. I can't touch it. I would love to be able to capitalize that money. I would pay the taxes. I would get it out of my hair, the taxes out of my hair, and I would deploy that money immediately to some opportunities that I see. But instead, it's sitting there trapped inside of a qualified plan that I'm in a partnership plan with the IRS on. Terrible place to be because you're really not gaining anything. And the most important element of any investment is time value. Time value is the most critical component, and it's working against you. You're giving that money to some other entity that has no relationship to you whatsoever. They could care less about you. I can better serve my needs by deploying that money. Maybe I'm not a great investor. Fine. I can find somebody who's a great investor, though, but I would love to be able to direct it to them rather than be boxed in by what some fiduciary says I have to do.
And the government is your fiduciary.
Well, no, the fiduciary is actually like the Fidelities of the world and those kinds of people. Gotcha. Those are the ones that are responsible for the money. The government just makes the rules that the fiduciaries operate under.
Sure.
But
so you're in partnership with the IRS basically over what your future tax obligation.
Yes, sir. Yep. You are.
I think you also mentioned the ERISA 1974, the Employment Retirement Income Security Act. What changes have happened since then?
So many. I mean, I was going to list them, Jared, but it would take a podcast just to talk about the changes. So anything that they've created, Congress created this monster. They can unwind and they can change. They've done it in the past and they're going to in the future. And so everyone is operating on the premise that the rules the snapshot that you see today is what we're going to have in 10 and 20 and 30 years from now. You will not. It's going to look very, very different than it does today. And do you really want to take the chance with... I really don't want to go down the political,
Sure.
road right now.
Sure.
But I mean, there's so much tension in government right now. They can't agree on anything. How in the world are we going to get a solution that works for everybody with a plan like this? I think it's best just to step back from that and take charge of it ourselves in a plan that we control, not rely on somebody else who just may have read 2 pages of a 300-page bill and comes out strongly for or against something. They're just not in a position to make a good judgment.
That's fair. I mean, just recent in COVID, didn't they lock your ability to pull from?
They did.
From those style funds?
They absolutely did. They absolutely did.
Yeah, so they locked those ability to pull from your funds during, the COVID crisis. And
you got to ask yourself why. Why would they do that?
Yeah.
Do you think it had anything to do with people's incomes being lower, needing their capital, needing their money? They couldn't access it, and so they were getting a proverbial run on the bank. It was starting. Maybe there was something to that.
Yeah.
Why else would they do it, Jared?
I know. I mean, when we talk about all the changes that have happened since 1974 to now, and then look at the next 40 years, what that looks like. I mean, I try to keep off the tinfoil hat often, but it's hard not to at least look at it through that lens, just for a lens of reality, just to look at it through a little different, mindset of what it looks like to you, so that you can plan accordingly. And when you've got them in these systems, when it's in a whole life policy that you control, you're the one that controls where it goes and how it gets there. I don't have to ask the government if I'm going to take a loan on my cash value of my account.
Yeah. You have the ultimate control with a dividend-paying whole life insurance contract. Once these things are set up, you have you're first in line. You can move the money within a matter of a couple business days and deploy it as you need to. Versus, I need $10,000, $20,000, $30,000. Let me go to the bank and ask for it. When we went through, you probably remember, Jared, some of the other banking crises. I don't know if you remember back as far as Lehman Brothers in 2008. I do. And you could not get a loan. Yep. You couldn't. I mean, it was an absolute meltdown. Everything was in chaos. Were the life insurance companies in chaos? Was this process in chaos? Absolutely not.
Sure.
Easy.
Yeah.
So the amount of safety, security, and control of your capital really was what it amounts to.
Yep. So. That's awesome. So as we're doing just kind of a 30,000-foot view from the retirement trap, how would you sum that up? Well,
Jared, it's about taking control of the outcome. Begin with the end in mind. Everyone has heard that, right? The 7 Habits of Highly Effective People, right? You've read that book. If you haven't, you should. But begin with the end in mind. So here you've got a vision of where you want to go. We should begin knowing where we want to get to. Otherwise, as Yogi Berra says, if you don't know where you're going, you'll probably get there. So begin with the end in mind. If I'm controlling the inputs and I have my vision on where I want to go, the likelihood of me getting there is far greater than if I say, here you go, and I pass over all of my assets to somebody else who doesn't even know my name. They don't even know where the money came from. And you're pointing in this direction. And they're going to change the rules. And they're going to point in their direction, not in mine. And I'm going to wind up in the back end of this thing going, how did I get here?
Yeah.
What now? You got to retool. Start all over again.
That's pretty common. I mean,
it's extremely common. And it's going to...
Talking to the boomer generation right now, coming into the retirement era, and how either little or amount that is there to be dipped into what they're going to pay tax-wise compared to what they thought it might be. I mean, we've got to at least consider learning some of the lessons from what's gone on so far.
We have to. We absolutely have to, because if we don't, we're going to suffer the consequences of what we haven't planned.
Or repeat it.
Yeah. Well, the axiom in history, right? Those who don't know their history are condemned to repeat it, or something like that.
That's right.
But sure, take control. What the infinite banking concept does is it puts your future in your lap to have direct control over the foundation of all of your financial affairs. Doesn't mean you don't invest. Doesn't mean you don't invest in risk capital. It doesn't mean any of that stuff. All it means is that you control where that money ultimately goes, not somebody else. And while it's sitting there and you're thinking about it, you're getting a very nice tax-free rate of return internally. How nice is that?
Yep. The other thing that would be a little off script here, but at least worth adding, this doesn't follow the book sequence, when you think about retirement and you think about maybe just 70 to 90, at some point in there, you're going to probably need some long-term care as well. Would you prefer to just run through all of your money and have a Medicaid product? Or would you prefer to have some of your own funding available to pay for a nice or nicest property where you're going to be? And who's giving you care and at what frequency when those days happen? Because as much as we don't want to admit that it's coming. That's all just a natural part of life.
Yeah.
And these contracts that we set up at no cost, it's included in these dividend.
Up to a point, of course.
Correct. Up to a point, of course. But there's no cost of setup, I think is the better way to say that these are a part of your properly structured dividend paying whole life contract where you have access to not just some of the cash value, but some of the death benefit if you can't do 2 of the 6 activities of daily living.
Yeah.
So again, it kind of functions into that retirement piece, but it's a little different.
Yeah, it is not a true long-term care product.
That's right.
The great long-term care products they've sunset because they were great, and it was costing the insurance companies too much money, and they weren't profitable. Sure. So they did away with them. So, but what we do have inside these contracts is the ability to, as you said, if you can't do 2 of 6 activities of daily living, if you have a specified medical condition, which is defined as a type of cancer or heart issue, and then the final one is the terminal illness. If you're going to pass within 12 months, according to your physician, is access to not the cash value but the death benefit at that stage, and that's on an order of magnitude greater than just the cash value. So.
And not all of it. It doesn't give you access to all of the death benefit.
Right. And it phases out too.
That's right.
65. It depends on the company. When they cut, you're not going to have this at 80 years old.
That's right.
But when you're a younger man or woman and something happens in your life, you have a realtor who had the motorcycle accident would have access to that capital.
Well,
right?
And just to clarify what you're saying, you would have access to that at 80 years old if you had built these policies up over the course of many years, right? So you start these products at 35 years old, you pour into these for the course of 30 years, and at 65, maybe you stop contributing to your account. Maybe you stop paying premium. Maybe your contract doesn't allow you to pay for premium.
As long as you have cash value in there, you're good to go.
That's what I was wanting to make the point of.
Okay.
At 15 years later, even though you haven't been paying premium for 15 years, and it's been continuing to grow from 65 to 80, and then at 80, something happens. Your wife is no longer here. Your kids are living out of state. And now you need some way to make sure that you're taken care of day to day.
Right.
And you can't do 2 of the 6 activities of daily living. You can dip into this contract that you've been building at that point for 45 years.
Even when that rider terminates, it's no longer available to people inside that contract because there is a termination. Depends on the company.
Yep.
You have your cash values.
That's right.
And those cash values, you can set up a program distribution down to a minimum death benefit if you want to do that.
Yep.
Those are a very nice planning feature because when you're taking money out of the contract, remember you can draw down to basis. Everything you put into that contract comes out tax free.
That's right.
Now, if you begin to pour out of there and you go beyond that and you begin to take distributions, then yes, the gain would be taxable as ordinary income tax. But that's way downstream. And at that point, you don't have any other income, probably.
Do you have to guess on this, or do you have the tools available as a agent to be able to kind of forecast what that might look like?
Oh, sure, you can forecast, and of course, it comes off the illustration. And illustrations are guaranteed to be incorrect.
Guaranteed
because those numbers are going to be something more or something less. They're not going to be exactly those numbers. It's just the best approximation that an insurance company can do based on all their data going back a very long time. So they're pretty good.
An illustration in itself is worthless the day you print it.
Exactly.
Yet it can be a good idea of what to expect. You're not going to hold. It's not a contract that you're printing out.
Yeah.
Yet you can do a lot of planning pieces. So that would be something that John or I could offer, is that if you wanted to see how many, what kind of dollars you put in over the course of 25 to 30 years, and then 15 years later, how much could you pull out to use, and what that would look like, how that would impact the contract. That's all in the planning.
It's kind of like flying to Europe, right? You get the weather report, Jared, and they tell you what the winds aloft are and what the weather is ahead.
10 hours old by the time you get there.
Yeah, and then how accurate are those winds and the weather systems in front of you? And there's no turbulence ahead, and all of a sudden you're rocking and rolling over the Atlantic. What happened there?
Or when you're that first flight over the Atlantic, and there hasn't been a flight over the Atlantic for the last 12 hours.
Yes.
So you're kind of a test pilot.
You're the guinea pig.
Well, that's awesome. Well, another great episode, John. Thanks for everybody for tuning in. Any closing words?
Today, no. Thanks for joining us, everybody. We appreciate your tuning in to Creating Tailwinds, and we look forward to finishing up the book with you.
Fantastic. Thanks, John. Have a great day. Talk to you soon.
You too, Jared. Thank you. We'd like to thank you for tuning in to today's episode of Creating Tailwinds podcast with your hosts, John and Jared. As always, we welcome your questions and critiques. You can reach us through the Contact Us tab at flightpathfinancial.com. Remember, it's all about how you think. As Nelson Nash has said about infinite banking, give it your close attention, and it can make a radical improvement in your financial future.